In this video, I'll go over all the essentials you need to know in order to invest in mutual funds, and we're starting right now. Hey guys, Elliot here. So as an investor, you absolutely need to know about mutual funds. They are relatively simple in concept, and because they provide pretty good returns and mitigated risk, mutual funds remain one of the most popular ways to invest in stocks. So let's cover all the essential concepts and how to get started investing in them. As always, if you enjoyed this video and find it useful, please do subscribe to the channel, helps me out a lot, and smash that like button. Okay, first off, let's define what we're talking about here. A mutual fund is a pool of money from many investors used to purchase securities such as stocks. Each investor buys shares in a fund of their choosing and is now entitled to receive profits or losses that arise when the price of the stocks that make up the fund go up or down. It's really that simple, and instead of picking individual stocks yourself, you're just buying shares in a fund that you picked. There are some advantages to doing this and of course some disadvantages, and I'll go over all that a little bit later in the video. So what essential information do you need to be an informed mutual fund investor? Well, first of all, you need to understand that there are two types of mutual funds, actively managed and passively managed. Let's tackle the passively managed one first because they are a lot simpler. As the name implies, there really isn't any active management involved with running these types of mutual funds, and they are automated to run passively or on their own. In order to do that, however, they need to follow some kind of methodology for picking stocks that they will invest in. And they do this by simply following indices, such as the S&P 500, for example. And they end up investing in exactly the same stocks in the same proportion as these indices. Not surprisingly then, passively managed funds are often referred to as index funds. And they are one of the most recommended investments that financial advisors will usually suggest to both beginner and advanced investors alike. Why, you ask? Because they're very understandable, straightforward, inexpensive, and give you the same returns as the overall market, which historically averaged about 10% annually over the last 100 years. How do you open up a passively managed index fund account? Well, you just pick what broker you want to use, such as Vanguard, Fidelity, Schwab, or any of the discount ones, such as TD Ameritrade or E-Trade, among many others. Once you contact them, open up an account, then fund it, you just pick the index fund you want and start putting money into it. Some of the biggest and best known index funds include the Vanguard 500 Index Fund, ticker symbol VFINX, the Fidelity 500 Index Fund, ticker symbol FXAIX, and the Schwab S&P 500 Index Fund, ticker symbol SWPPX, among others. There are also index fund ETFs, which are not really mutual funds, they're exchange-traded funds, but they behave very similar. I do actually have a video on ETFs if you want to learn more, and the link is in the description below. In my own case, the large chunk of my investing, such as my 401k, it's tied up in passively managed index funds that follow the S&P 500, so I'm a huge proponent of having index funds be a significant part of your investing strategy. When you're looking around to select a passively managed index fund, be sure to check all the expenses. Fortunately, these types of funds have the lowest fees in the business, and anything from 0.015 to 0.03 is considered excellent. How much is that in actual dollars? Well, with a 0.0% fee, if you invest $10,000, it'll cost you about $3 annually. Okay, so those were the basics of passively managed index mutual funds. Now let's talk about the actively managed ones. First off, what exactly are they? Well, as the name implies, these funds have a fund manager or several managers, and very likely a team of analysts and researchers to back them up as well. Their job is to pick the stocks that go in the fund and hopefully pick them well. So these funds are for those investors who believe they can outperform the market and not just passively track an index. Managed mutual funds are really all over the place in terms of what they can invest in. Some, for example, invest in only tech or biotech, others only in energy or real estate. Still others may only invest in green energy or defense or vice stocks. There's really no limit what they can decide to focus on, and your challenge as an investor is to decide where exactly you want your money to go. As you can probably tell so far, the actively managed funds are a bit more complex and not quite as straightforward as the passively managed ones. They are also more expensive for the investor investor, and I will talk about some of those fees in just a moment. The reason they're more expensive should be fairly obvious because they have a pricey management team in place, and they also typically promise superior results if you invest with them. Whether or not this actually happens is another topic, one I will get to shortly as well. For now, let's go over some of those fees that you're likely to encounter. There are two broad categories of fees that are typically associated with actively managed mutual funds that you need to know about. Not every fund has every fee, but you will definitely run into these very quickly in this business. The first expense is called the load. These are transaction fees for when you buy and sell shares of the mutual fund, and they are typically assessed just once during a purchase or a sale. The second expense is called an expense ratio, and this is an ongoing investing fee that you will pay annually even if you don't buy or sell any shares. Let's take a moment to take a look at loads and expense ratios a bit closer, as this is pretty important stuff for actively managed mutual fund investors. So loads are just another name for commissions and are paid out by the fund to brokers and other agents. When you hear of a fund being referred to as no load, this simply means there's no fee to purchase shares of the fund. You should be aware of a few different types of loads. The first I just mentioned, and there are quite a few no-load funds out there, with even more appearing in recent years. Still common, however, are funds with a front-end load. This means the fund charges you up front to purchase shares, and it's usually a one-time fee regardless of the size of the purchase. Front-end loads are expressed as a percentage, that is $10,000 invested all at once, with a 5% load is really $9,500 invested and $500 in fees. Finally, there are back-end loads, and as expected, these are the fees when you sell the shares from the mutual fund. They can get a bit more complex, however. In order to incentivize investors to buy and hold, the back-end loads may diminish progressively, say from 6% in the first year down to 0% by the 6th year of holding these shares. A typical fund may have a combination of both front and back-end loads. So research this topic carefully before investing by reading the prospectus, and make sure you understand exactly what the fees are when you invest with this fund. So loads are just the entry and exit fees to invest in a mutual fund. What about the expense of actually running it? That is the second item to discuss in a little bit more detail, and that is the expense ratio. As I just mentioned, it represents the ongoing expenses of running the fund and is often referred to as a management expense ratio, or MER. The cost is taken out of the fund's market return, so investors end up paying for it, if not directly, then indirectly. The biggest chunk of the expense ratio for actively managed funds is usually the fund's manager and his or her research team. Fund managers typically get paid a percentage of assets under management and get their commission regardless of the fund's performance, although it will certainly be a very short tenure if the fund underperforms significantly. This fee can vary from about 0.5% to about 2% annually. Also, keep an eye out for what are called 12B-1 fees, which are just another set of fees associated with promotion and marketing of the fund. So that was a lot of fees that I just went over. And as you can imagine, not only is there some federal regulation as to how much these funds can legally charge you, but also the funds try very hard voluntarily to try to reduce these fees to compete among each other for your business. Some of the terminology you need to know about regarding the discount on fees include the concepts of breakpoint, right of accumulation, and letter of intent. Let's go over all three of these in a little bit more detail. A breakpoint is nothing more than a reduction of the load fees once you hit a certain tier of purchases. It's no different in principle from, say, Walmart giving you a 10% off a package of 10 paper towel rolls versus no discount if you only buy 5. With mutual funds, you may pay a full 5% fee if you purchase $10,000 of shares in a fund, and then drop to 4% if you purchase, say, $20,000 in shares, and so on and so forth. Now, breakpoints are the main concept here, and the other two terms simply support it. A right of accumulation, or ROA, just states that it's your total cumulative investment, not the one-time purchase amounts, that dictate your breakpoints. Finally, a letter of intent, or LOI, is simply a legally binding promise that says you will buy more shares up to the breakpoint at some time in the future, and you'd like your discount or breakpoint right now. Needless to say, say if you don't hit the share purchases that you indicate in your letter of intent, you will get charged a higher fee. Okay, so all of this information I just covered comprises the absolute basics of mutual fund investing. There's of course more to it, but you have enough info now to potentially start investing in mutual funds. A few outstanding questions still remain, however. First off, which do you pick? Passively managed index funds or actively managed funds? Well, really there are two very different creatures. If you have no desire to try to beat the market and want a hands-off investing approach, then index passive funds are definitely the way to go for you. And a sizable chunk of the investing public, including myself, does exactly this. Managed funds, however, are an option for those who are more of the active investor type, and for people who think they can invest to beat the market and get better returns. Now, it's really important to mention that actively managed mutual funds do not beat the market all that often, with some financial researchers pointing out that this happens consistently in only about 20% of the cases, which means 80% of the time you're better off investing in just an index fund, as those are far cheaper. It's also important to point out that the fees charged by a mutual fund is not an indicator of its performance, and higher fees do not necessarily translate into higher returns for the investors. When looking at actively managed mutual funds, you have to look at the fund's total return, which is a metric that will give you a feel for how successful the fund and the fund's manager really is. You should also look at the relevant fees and expense ratios, and with all else being equal, choose the fund with the lowest stated fees. Having said all that, however, some actively managed funds do manage to return some very spectacular results, especially when helmed by a very talented manager or management team, and several such managers such as Peter Lynch, T. Rowe Price, or John Templeton, just to name a few, have risen over the previous decades to legendary status. Finally, in conclusion, it's worth asking, why invest in active mutual funds at all? Why not just pick stocks yourself? Well, the truth is, doing research and picking stocks yourself is perfectly fine, and I do this myself quite a bit for my ultra high dividend portfolio. What these funds do, however, is diversify your investing and make life easier for you by placing the research and the stock picking in the hands of professionals so you don't have to do it. It's also presumed that professional managers and analysts will give you better results than just investing in an index fund or picking your own stock portfolio, which is exactly why investors agree to the higher fees. Now, as I mentioned earlier, this isn't always the case, but when you do pick a winning fund, the results can be quite impressive. Let me leave you with one more piece of investing advice regarding passively managed and actively managed mutual funds. It's widely believed that in a rising market, you should invest all your money in passive funds, as the entire stock market is rising and there's no need to pay anyone extra money to pick winners in an already rising market. In a sideways or down market, you should transfer your money into managed funds, as talented managers can then pick and choose winners among many declining stocks, while a passive index fund will just go down uniformly across the board. Alright, these are the basics of mutual funds. If you've enjoyed this video and found it useful, please do subscribe to the channel, helps me out a lot, and be sure to turn on notifications so you don't miss any more videos just like this one. Thanks for watching, and I'll see you soon.